The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic.
A big reason for the good news, gas prices are leveling off, and that's certainly helpful to consumers.
I expect at the end of this year, the federal funds range will be 3.25% to 3.5%. We do not expect that we are finished.
We have to still keep our eye on the ball. As we've said all along, there's no silver bullet here.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Keeping it cool, stocks surge as U.S. inflation comes in softer than expected. The dollar slides the most since March 2020. The Fed unswayed despite the CPI data. FOMC officials vowed to stay the course on rate hikes plus magic numbers. Disney's new subscribers top estimates as the company raises the price of its flagship streaming. Now let's check on the markets. Yesterday certainly was a pretty important day when it came to markets. We saw that rally, the rally continuing. European stocks gaining some 0.2%. We're seeing a similar gain when it comes to U.S. futures. Now partly, of course, it's really unsurprising after that inflation print we had from the U.S. that the Federal Reserve expectations have recalibrated for the month of September towards a 50 basis point hike. What that means is that it's basically unwinding some of the payrolls repricing, and it's filtered through a lot of the asset classes. The question is, have they gone too far in that? Because we're still seeing stubbornly high inflation. We heard from Neil Kashkari and others, of course, from the Federal Reserve saying, guys, it doesn't really change that much on what we intend to do. Euro dollar 103.23, the U.S. 10-year. Interesting to see, of course, the inverted yield curve, what it happens when you look at the 210s, 2.7644, and then crude oil down some 0.6% at 96.78. Now, without a doubt, a lot of focus on energy. We have a lot of blueprints, for example, how some of the individual countries would react to a full-on gas embargo from Russia. It's going to be different here in the UK. We have price caps, but again, the price caps here are just quarterly, so they're not as, for example, significant as they are in France, where the government and Emmanuel Macron, the president, has gone as far as nationalizing the main utility EDF. But now, speaking, of course, of energy prices, IEA coming out saying oil use is growing faster as some of the gas crisis spurs fuel switch. So they see a shift, of course. The main question we'll also ask Toril Bosoni, the IEA oil market division head, is at one point, does all this talk about possible, not inflation expectations, but this talk, of course, of blackouts mean that people will stop using so much energy? So we'll get back onto that. Economic outlook, they're saying, has knocked some $30 from the oil price. So don't miss our interview with Toril Bosoni coming up very shortly. Now, U.S. inflation came in cooler, below estimates in July. We all know that. Consumer prices rising 8.5% from a year ago, down from 9.1% in June, with lower gasoline prices the main driver. Now, Bloomberg TV guests have weighed in on the data and the implications for Fed policy.
This was a good report.
This data allows us to breathe a sigh of relief.
It's nothing like we are out of the woods.
The Fed still has plenty more work to do.
We do not expect that we are finished.
The Fed is still going to hike in September.
This is still a go, perhaps for 75.
Our goal is for 50
basis points.
We're looking back at 50 basis points.
It looks like it's going to be 50, 25, 25, which is a more moderated pace.
That is still a ton of tightening.
I expect at the end of this year, the federal funds range will be 3.25% to 3.5%.
The market's not believing that the Fed has yet done enough to bring inflation down anytime soon.
This is just the first hint that maybe inflation is starting to move in the right direction, but it doesn't change my path.
Now, to talk about inflation, joining us from Hong Kong and Curran, our chief Asia economics correspondent in London, Justina Lee, joins us from our cross-asset team, and Thanos Parasavvas, chief investment officer and founder of consultancy firm ABP Invest, also joins us. So thank you all for being with us today. And let's start with you. In July, Jay Powell, of course, speaking of the need to see compelling evidence in the moderation of inflation. We didn't get it yesterday, did we?
Well, this is the big debate now. Have we actually seen peak US inflation? Are we at a turning point into disinflation, not just for the US, but perhaps globally? I don't think anyone's really brave enough to call it. We've definitely turned that corner, Francine. You know, in terms of the US data itself, there are some views that perhaps weak productivity and still increasing wage gains could yet push up core prices, by the way. Bloomberg Economics say core inflation in the US has not yet peaked. So that will certainly be, won't go unnoticed by the Fed. But even if you leave aside whether it has peaked or not, we're still in a scenario whereby both US inflation and inflation in many other parts of the world is still very high, and of course is driving a punishing cost of living crisis for people, and central banks will need to act, and the Fed is among those. The Fed certainly will continue to raise rates from here. Whether it's going to be 75 or 50, of course, the economists will debate, but the point is that interest rates and mortgage rates will be going up. It won't be just the Fed, it will be central banks around the world, because the inflation story is far from over.
Yeah, and Justine, I guess the question is, it does feel like Fed speakers don't want to declare premature victory over inflation. Are the markets just reacting too quickly?
Well, I think markets always kind of react to a change in expectations. And we've already seen that show up, in the markets. For instance, now people are kind of expecting either a 75 basis point hike or a 50 basis point one next month. And, the probability is sort of split in the middle here. And that's already like a shift from earlier when everyone was talking about 75 basis point. So for the markets, we have short end yields coming down, which has been helpful to stocks, especially tech stocks. And I think kind of markets are reacting to a shift in that.
Thanos, I have a viewer, and I want to thank Anthony, because I think he writes on most days. And he says, the Fed has acknowledged that it was behind the curve. Is this not an opportunity to go 100 basis points, you hike in September, and then you see what happens?
Hi, morning, Francine. I don't think that they need to be that aggressive. I think the Fed was well behind the curve. We were negative on inflation, as you remember. But more recently, we think that inflation has peaked. We sent a note out in May expecting the inflationary sort of scenario starting to turn over. So we are not surprised with the recent sort of reduction in pace. However, we're very much on the case that the Fed should maintain a hawkish policy as per what we've been hearing overnight. It is very important for them to maintain that hawkish stance, verbally at least, and even if it means being slightly more dovish on the interest rate movement. So maybe 50 in September and maybe 25 in November.
And as a great student and as one of our most thoughtful, of course, thinkers on economics, is there a danger that inflation's coming down and then towards the end of the cycle it shoots back up, and that puts, of course, the Fed in a tricky position?
Well, this is the big quandary for central banks, Francine. They're kind of stuck between a rock and a hard place at the moment. They know growth is slowing. They know they have to be very careful in terms of how to go forward from here without tipping their economies into a very deep recession. But at the same time, they have to do what they can do to put pressure on inflation. That is, of course, raise interest rates. And I think that's the trajectory that we're going to be on for the near term, at least, that they will continue raising rates from here, not just the Fed, but other central banks around the world. Now, perhaps later in the year, we might reach that point whereby they all maybe start to take their foot off the pedal a little bit, start to pause and see where are we in the inflation story, and maybe even move in much smaller increments. But I think in terms of where we are in the cycle right now, it's still pretty hawkish. All the indications from the Fed, for example, even in response to the inflation data in the US, is that they still have a lot of work to do. And I think that's the space that we're going to remain in for the next few months.
So, Justina, what now? We have retail sales figures. I know we have, of course, Jackson Hole, August 25th, but we also have the University of Michigan data tomorrow.
Right, exactly. Because on one hand, people have been concerned about inflation, but the economic picture is very crucial as well. And I think one kind of fear among investors right now is that, are we going to see effects from the tightening start coming in? And are we even going to see, a recession? Earlier people were expecting even rate cuts starting next year. Because so far, the earnings season has been pretty solid, but a lot of strategists have started warning about upcoming quarters. And so I think, the upcoming data is going to be key on that front.
Thanos, do you believe that we definitely need an equity correction, given all of the uncertainty in the next 6 months?
I think it'll probably have to be from the earnings side, not so much from the inflation. We think that inflation is done in terms of the peak. However, we do expect it to remain slightly elevated in the more medium term because of the structural factors which suggest that the inflation will remain elevated, whether it's wage or sort of a normalization of equalization of pay, and slightly higher expectations. But in terms of the S&P risk, I think is more on the earnings side rather than the inflationary side.
All right, thank you all. I feel like we really had all angles covered. Enda Kern, there, our Chief Asia Economics Correspondent in Hong Kong, Justina Lee from our Cross Assets team here in London, and Thanos Parasavvas, Chief Investment Officer and founder of ABP Invest, stays with us. Coming up, Wonderland. Disney exceeds profit estimates. They're also raising the price of streaming service Disney+. We'll dive into their earnings next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Disney shares rally in pre-market trading. That's after third quarter results beat estimates for sales, profits, and subscriber growth. The world's largest entertainment company has now overtaken Netflix in terms of total subscribers across its streaming platforms. That includes ESPN. Now, let's get straight to our Bloomberg. Laura Wright. Laura, so how has Disney actually managed to gain the crown of streaming market leader?
Well, exactly. The new kid on the block is now the market leader. Total subscribers across Disney's platforms of Disney+, Hulu and ESPN+ now account for 221 million, as you can see from the orange here, fractionally higher than that of its main competitor, Netflix. This is down to the really strong performance of the Disney+ platform, which was only introduced at the end of 2019. Disney+ added over 14 million subscribers for the quarter, ahead of the Street's estimate, taking total Disney+ subscribers to over 150 million, as you can see here in the blue. That said, executives at Disney walked back their subscriber growth forecast on the flagship platform. Perhaps a consequence, they've lost the rights to the IPL cricket in India, which will be a headwind.
So what is Disney actually doing to mitigate the high cost of content, Laura?
Well, they've introduced adverts on their flagship services of Disney+ and the Disney Bundle. And if you want to avoid the annoyance of those adverts, customers will have to pay up a little bit more. It's an increase of $3 a month on Disney+, an increase of $2 a month on Hulu. This is because average revenue per user simply wasn't delivering. And you could argue that from this move, executives at Disney are prepared to lose some subscribers. And if we take a quick look at some of the legacy businesses, such as parks, here it was a beat on revenue and profitability. The key takeaway is that even though attendance is lower at Disney's parks than it was back in 2019, customers are certainly digging deeper into their pockets when they do visit, because Disney has invested in improving the customer experience. The traditional TV businesses such as ABC, well, that continues to fund the pivot towards direct-to-consumer. And on the earnings call, the CEO, Bob Chapek, was emphatic. Disney will continue to pursue this barbell approach in pursuit of growth.
Laura, thanks so much. Laura Wright there with the very latest on Disney. So let's continue the focus, of course, on earnings with Thanos Parasavvas, founder and chief investment officer at ABP Invest. Thanos, first of all, are you a streamer? Do you like streaming in terms of investments, or do they just look still too expensive?
I think that they still do a little bit, albeit we have had some correction from the highs. And in terms of our broader outlook, that we are heading into sort of a higher inflationary environment in the medium term, we do find a shift in terms of the value to growth. But it's still a little bit too early for us to jump into that. More generally, Francine, I think that monetary policy takes a little bit of time to work through. There is a lag. And we believe that the economy is going to weaken, even though we've seen a technical potential. We're in the middle of a technical recession. We do expect the economy to slow down. Unemployment is far too low, or employment levels are hot. We expect a gradual reversal. And also housing market, the affordability. So we do expect some impact in terms of earnings.
So Thanos, overall, I mean, we're just almost coming out of earnings. I know it was like a long slog. It was like 2-3 weeks of relentless earnings. What did you learn in that earnings season? Is it all about supply chains? Is it components? Is it getting easier?
We were pleasantly surprised with the output. We expected them to be slightly worse. We have been more cautious in terms of the S&P, but we do believe that the economic outlook is not going to help over the next few quarters. So We have been more bearish, but we don't see this turning positive at the near term.
Okay, where do you find it? What's your biggest conviction right now? Where do you find value?
We find that from an emerging market point of view, we find there's more value in emerging markets, whether it's on the equity side, whether it's on the fixed income side, predominantly because the central banks have been well ahead of the curve. Unlike the developed markets, the emerging market central banks have been tightening. We've already seen some signs of inflation turning around. The latest developments out of Brazil have been in favor of that. Also, the policymakers. We've had some left-leaning governments in Latin America, and despite that, they've maintained a very orthodox policy in terms of managing those inflationary pressures. So we like emerging markets. We like Japan. We like China from a valuation point of view, from a fundamentals point of view. We also like the UK. So it's not that we're broadly negative in terms of beta, not at all, but we still find that the US is expensive vis-a-vis some of those other regions.
Thanos, what do you like in the UK? Because some of the concerns, of course, is higher inflation. I mean, 13.3% is pretty high, policy mistakes, and of course, we worry about the level of sterling.
That's very fair, Francine. From a valuation point of view, we still find it attractive. We believe that sort of the exporting side of the FTSE, the impact in terms of exports, is going to be finding it supportive. And sterling, I agree with you that sterling has got some elements of political risk in case they pursue a very easy fiscal policy at the levels of inflation, at these current levels of inflation. However, we do believe that sterling at these current levels from a valuation point of view tends to be quite attractive and as a result should be able to benefit the FTSE in a similar way that the Nikkei had benefited from a very weak yen, which, by the way, would change our view on that. We're now positive again after the recent weakness. But the weak yen did support the Nikkei. We believe that the attractive value of sterling will support that.
But Thanos, the dollar. Yeah, the dollar is also exceptionally expensive. What happens the next 6 months?
We turned negative the dollar in March. A little bit too early, maybe. But we turned negative a dollar because we expected that the Fed will gradually stop. Inflation is going to start turning, and the interest rate differential and the economic differential will no longer support it as much. So we're positive the euro. We think that the euro is both from a fundamental and a valuation point attractive. The risk there is, of course, the potential energy crisis, which comes with the Russia-Ukraine. That is a risk event. But broadly, looking through that, the euro is attractive. The Japanese yen we find very attractive. And as per my earlier comments, the emerging market currencies are quite attractive, again, because of those sort of hard work of the central bank and policymakers that, despite left-wing governments, pursued orthodox macroprudential policies in majority. There are, of course, some cases, we know which ones they are, where they have not pursued them. So we're negative the dollar.
Thanos, thank you. Thanos Parasavvas, their founder and chief investment officer of ABP Invest. Coming up, we'll dig into the International Energy Agency's oil report with Toril Bosoni. I'm really looking forward to that interview in terms of demand destruction, in terms of price swings. She is head of the oil market division at the IEA. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A Ukrainian official has told the Washington Post that a powerful attack on a Russian air base in the occupied Crimea region was the work of Ukrainian special forces. If confirmed, the development would suggest an increasingly important role for undercover forces operating deep behind Russian lines. The official did not disclose details of how Tuesday's attack was carried out. Now, the UK housing market is feeling the pressure of rising interest rates and a squeeze in the cost of living. The latest report by the Royal Institution of Chartered Surveyors shows sales expectations for the next 12 months are at the lowest level since March 2020. New buyer inquiries fell for a third month. The slump has yet to translate into falling prices. The crisis on Europe's rivers is expected to worsen. The Rhine River is set to become virtually impassable at a key water point in Germany. Authorities say the water marker at Kube, west of Frankfurt, Frankfurt will drop to a critical depth of 40 centimeters or 16 inches this Friday. At that level, most barges that haul goods will be unable to pass through, choking off energy and industrial shipments. U.S. Commerce Secretary Gina Raimondo says Nancy Pelosi's visit to Taiwan has complicated trade talks with China. President Joe Biden is re-evaluating Trump-era tariffs on $300 billion worth of Chinese goods. Raimondo says Chinese officials had been hesitant to engage in talks even before Pelosi's trip.
Certainly has made it a little more challenging. As I said, at this moment, it's harder, but I am hopeful that we will get beyond that and get back to a place where we can have more of those discussions.
Staying in the U.S., Donald Trump has declined to answer questions from New York's Attorney General as part of an investigation into his family's business practices. The former president repeatedly invoked his Fifth Amendment right against self-incrimination in a deposition probe whether his organization manipulated asset valuations to secure bank loans and also insurance. The legal submission comes 2 days after the FBI searched his home in Florida. Trump does deny any wrongdoing. Global news 24 hours a day on air and on Bloomberg Quick Take. This is Bloomberg. Francine.
Leanne, thank you so much. A full roundup of oil next. Keeping it cool, stocks surge as U.S. inflation comes in softer than expected, while the dollar slides the most since March 2020. But the Fed is unswayed. Despite the CPI data, FOMC officials vowed to stay the course on rate hikes. Plus, magic numbers, Disney's new subscribers top estimates as the company raises the price of its flagship streaming service. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, energy has been one of this year's biggest issues globally. The price of oil broke above $100 for the first time in almost 8 years. Natural gas continued to surge to new heights, and both commodities helped drive inflation to 40-year highs. Ørsted, the world's biggest developer of offshore wind farms, reported, for example, results this morning. We spoke to the chief executive, Matt Nippers, and he says that it's not an either or between investing in renewables and securing short-term supply through things like LNG.
I mean, this is not an either or. It has to be a both and, because we cannot magically get sort of tens or hundreds of gigawatts of renewable energy before winter. So it is a matter of saving energy. It's a matter of securing sources of short-term energy supply, and of course, then more strategically to get the independence from fossil fuel imports. And by the way, also to combat climate change, we need to keep the push long-term and mid-term to roll out and accelerate renewable energy.
And then the IEA just released their monthly report and boosted forecast for global oil demand growth this year. That says soaring natural gas prices and heat waves force industry and power generators to switch their fuel to oil. Well, we're delighted to be joined right now by Toril Bosoni, head of the International Energy Agency's Oil Markets Division. Toril, as always, thank you so much for joining us. The IEA has described the OPEC increase as symbolic. Were you disappointed by the 100,000 barrel a day increase, and can they do more?
Well, we're seeing the increase is small in relation to what we've seen in the recent month. Obviously, we saw a big surge in OPEC production in July, and there's coming another increase in August. As OPEC noted in its communique, they're worried about spare capacity that is dwindling. Now it's basically only Saudi Arabia and the UAE that is holding any substantial amount of spare capacity. So we weren't really surprised by the increase. Now, of course, there's a lot of uncertainty on the demand side. So this is also something that the OPEC is factoring in its decision making. But of course, the OPEC group is meeting every month. They can adjust as and when they see that needed.
But I mean, the question, I guess, Toril, is, and you rightly say, they say this is to preserve spare capacity, but is it also because they don't want to break away from Russia? So it's a win-win situation if they want to hold the group together.
Well, of course, I cannot speak for the OPEC and what determined their decisions, but it's of course something that the OPEC group has stressed. The cohesion within the group has been important. They maintained this this alliance now for some years, and we see that as factoring in as well in their decision making.
I mean, there are doubts that are persisting over Saudi Arabia's ability to sustain 12 million barrels a day. Do you believe that they can do it? And for how long?
We do believe that they can do it. It's not certain, as they've stressed, if they want to do it. As they say, they want to maintain some spare capacity for supply disruptions. But we do expect Saudi Arabia to continue increase. Their target now is at 11 million barrels a day come August, a marginal increase again in September. And we think they might try to hold it here. They have the ability to increase by about another million barrels a day. But we don't think that they will use it for now. But we are certain, or we're confident that they could if the need was there.
Toril, do you see the scope for extending the release of emergency stockpiles beyond October?
Well, that's obviously an option. Our member countries, as we said in the latest month, in June, that we have data, we saw a record amount of emergency stocks, more than 30 million barrels hitting the market. This continued into July and August, and there's still about 150 million barrels of oil, a part of this emergency release and individual country releases that will hit the market over the next few months. But as the IEA has stressed, we still have a lot of emergency stocks in our member countries that our member countries are ready to use if and when required. So this is something that also will be discussed once we evaluate the market. Once this current release is completed, our member countries will make that decision to see if they want to continue and release additional barrels.
Toril, it feels like every day we have very discouraging or very worrying news on the energy sector. We talk about possible blackouts. Of course, every country having to think about what industry in Europe they keep alive or not if there's a full gas embargo. What can you tell us about the low level of the river Rhine? How much disruption, how much does that hurt oil and gas?
Yeah. That's something that we've looked at as well. The product supply situation in Central and Eastern Europe was already very tight before this latest crisis related to the low water levels. That's due in part to refinery outages, planned and unplanned in Hungary, Slovakia, and in Austria, and in Ukraine, of course. So we were already expecting product deficits increasing to about 900,000 barrels a day by August. And the low water levels makes it more costly to get fuel from the water for the seaborne market into that regions. Other routes are available. You can truck in along the Danube, but that's costlier. So this is a concern to those countries, landlocked countries in Central and Eastern Europe that normally get fuel on the Rhine levels. So we're expecting this situation to continue throughout towards the end of the year. It will get better once the refinery gets back online, but it is a concern to those markets.
And Toril, how do you see the Chinese recovery? Are you making any adjustments to your forecast for China? Because COVID clusters has also meant that we've had to stop and start some of the regions.
We did. In this report, we were expecting Chinese demand to recover. It did recover strongly in June. But in July, we saw renewed lockdowns in several regions in China. So now we're expecting, we have delayed the full recovery by 2 months compared to our earlier expectations. So by August, we think we will get back to pre-COVID levels. Aviation sector is recovering, but we are seeing continued slowdown in trucking and industrial activity due to the latest lockdowns. So a few more months, but strong recovery, and a very strong recovery for 2023. This year, for the first time this century, we expect Chinese oil demand to decline year on year. It did not decline during the first COVID lockdowns, but strong growth as they recover in next year.
Thank you so much, Toril Bosoni, there, the head of the IEA's oil market division, with a very important interview after a very important IEA report. Coming up, Daimler Trucks reports better than expected quarterly earnings despite supply chain issues. We talked to the chief executive, Martin Daum. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn to earnings. The German industrial giant Siemens has recorded a loss following impairments, as well as a drag from ongoing component shortages and pandemic lockdowns in China. Now the chief executive, Roland Busch, spoke with our very own Danny Berger.
The only market which was not that strong for our Q3 was China. It was flat due to the lockdown, obviously, but our people are catching up already in June and going forward. So if you look in our markets, we expect that this demand holds on. Major reason for that is that we do believe that our customers, they want to drive their sustainability agenda. They have to reduce their CO2 emissions. They have to go for more resilience, but also for digitalization and automation. And that plays into our hands. This is our strategy, our portfolio. So we see unbroken demand in our markets also for the next quarters.
Talk to me about the other side of that, though. The demand is strong, but what about in terms of getting the supply there and protecting margins, given the high inflationary environment we're in?
Yeah. So let's talk about the supply chain, particularly the semiconductors. So we see a little bit of an ease. It's not a de-warning now, but we see that it's a little bit relaxing. Let's see how that goes forward. On the other side, if you talk about the price increases or the inflation, our economic equation is positive. So that means with our pricing changes to customers, which we are moderately adapting in order not to overdo it, we can overcompensate the price increase, the cost increase from our suppliers.
Is there any other levers you can pull besides pricing power at this moment? For example, are you looking at things like remuneration, those sorts of things, again, to sort of get margins under control, considering, in this environment, there's just only so far you can go with pricing up for customers?
Yeah, I mean, of course, number one is we have this equation, the economic equation has to play right, and we do have pricing power, so that means we can push any kind of price increase also to our markets. On the other side, even though I said that we see still a strong demand from our markets also going forward for the next 3 to 4 quarters, we are cautiously. So we are really looking for any kind of cost savings. We are slowing down to be prepared. We do not slow down in our R&D and our spendings into the future, because that's what we believe in, that it helps us also regardless how the market does. But have in mind that even if something happens, the demand for our portfolio is still strong.
Well, that was the Siemens chief executive, Roland Busch, speaking to Bloomberg's Danny Berger. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gehrens. Hi, Leanne.
Hi, Francine. Deutsche Telekom has raised its earning guidance for the full year after forecasting that customer growth in the US will speed up. There was also better than expected revenue growth in European markets. Deutsche Telekom wants to take full control of the T-Mobile US business. It has become the company's primary growth driver. Now, petrol prices keep falling in the US, according to AAA. The average price of a gallon of regular petrol has dropped to $3.99. That is the lowest since early March. Costs have fallen due to cheaper oil and relatively weak demand. By one measure, fuel consumption is lower than it was 2 years in the midst of the pandemic. Elon Musk is accusing Twitter of hiding key witnesses in their legal battle. According to sources, Musk says the social media account isn't producing the names of employees responsible for evaluating the number of spam and robot accounts. Musk recently sold $6.9 billion worth of Tesla stock, saying the funds could be used to finance his Twitter buyout if he loses that legal battle. Coinbase says U.S. regulators are investigating its so-called staking programs, which allow users to earn rewards for holding certain cryptocurrencies. The largest U.S. crypto exchange says it has received subpoenas and requests from the SEC for information about certain customer programs. Staking service allowed crypto exchanges to diversify revenue away from trading. Harris Associates has disclosed a stake in Credit Suisse of more than 10%, cementing its place as the bank's biggest shareholder. Harris said in a regulatory filing that the investment firm owned 266 million shares, or 10.1% on the total as of the 31st of July. Harris has stuck by Credit Suisse despite a 78% drop in the lender's share price since 2013 when it first disclosed its stake. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much for the update. Leanne Gerrans. Now let's get some earnings news. Daimler Truck says demand for commercial vehicles will continue to outweigh supply in the second half of the year. That's after the German manufacturer reported better than expected quarterly earnings. Now joining us now is the Daimler Truck Chief Executive, Martin Daum. Martin, thank you for joining us. Now before we get onto the earnings, there's one big concern is that if there's a gas embargo from Russia, then Germany and other countries will have to face the decision on what continues being made or not. Have you had discussions with the German government about whether you'll be able to continue to keep your plants open if there's a gas embargo?
Absolutely, we are monitoring the situation closely. We are involved in all the talks of the automotive manufacturers associations, as our talks with the energy agency ourselves. We are increasing our savings efforts. Yep. We have alternative plans in place to replace natural gas by electric energy and by oil. And for the remaining amount we need out of chemical processes, the natural gas, we have clearly stated our demand. And for the time being, I'm pretty confident that we can manage our way through the winter.
So do you have assurance, or do you know if your key suppliers will also be rated as essential manufacturers so that you can get those components?
I wouldn't place my bet on being an essential manufacturer. And yes, you're fully right in that very entangled supply chains. Any one supplier can ultimately bring the system to a stop. But as I said, I'm still confident that we will manage it through the winter.
How are COVID lockdowns in China actually impacting your business?
I mean, they don't impact our business outside China, they impact our business inside China. So outside China, no impacts by COVID. Inside China, a lot. The Chinese market in the second quarter was down by 70% compared to previous year. And with our strong presence there, with our joint venture in Photon, we endured a loss in China, the only market where on the truck side we had a loss, and that had certainly a smaller impact on our overall result, a big impact on our Asian results.
Yeah, so Martin, of course, if you look at some of the challenges, we've talked about some of the supply concerns that we could see. We talked about rationing. We talked, of course, about some of the must-to-do list if there's a gas embargo, and we talked about China. What is inflation doing to demand of your trucks?
I mean, at the moment, the demand is still strong. Trucks are getting used up. We couldn't deliver in the past 18 months everything the customer were demanding, though there is a huge pent-up demand that will carry us definitely through the majority of 2023. We see 2022, we are completely sold out. And for 2023, we haven't opened our order books yet. But the moment we do it, we will see a huge spike in orders for that period.
Are you hearing customers cutting back on orders because they worry about a recession into next year?
No, not yet. For me, it's everything we see so far on freight markets is rather going back to a normalized strong market instead of having those peaks we had previously where freight demand couldn't be fulfilled. No, it's still strong, and the construction industry are still going strong. And now with the US just passing the infrastructure bill, I could see here a strong demand out of that side of the business in the upcoming months and potentially even years.
Martin, thank you so much. The Daimler Truck Chief Executive there, Martin Daum, with some of the biggest pitfalls in the next 6 months, but also opportunities. Coming up, keeping it cool. Stocks surge as U.S. inflation comes in softer than expected. We'll discuss that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, U.S. inflation came in cooler and below estimates in July. Consumer prices rose 8.5% from a year ago, down from 9.1% in June, with lower gasoline prices the main driver. Well, joining us now is Marcus Ashworth from Bloomberg Opinion. Marcus, first of all, thank you for joining us. I know you have great thoughts on inflation, but is the market ahead of himself in thinking that from now on inflation will cool off?
I mean, look, it's nice to see a decent downturn, but it is just going to, I think, bump along around here for some while. What we've seen is the transitory bits being exactly what they were. You know, they came up very sharply, they're starting to come off very sharply. That's now feeding through. Unfortunately, when you have a bit longer of transitory than we had initially hoped for, it becomes stickier. And it's the stickier things, particularly like housing, for instance, which are continuing to edge up. And that's why the Fed is not buying into this. You know, we've seen the peak of inflation. Firstly, it's going to have to be for several months, and it's going to have to be substantially lower than where we are on core CPI, you know, back below, well below 4, I think, probably even 3 handle for them to even begin to think about pausing, let alone cutting rates.
So, Marcus, in July, Jay Powell spoke of the need to see this compelling evidence of moderation in inflation. I mean, is this a trend that they're waiting for, or is it actually a number?
No, it's a trend, and it's across the board, and it's a raft of different things, and they can see, you know, evidence that, you know, clearly there's some softening in the labour market, that'll be one key indicator, but also, as I said, these stickier types of inflation, which are harder, the built-into inflation expectations. You know, they want to make sure there's no wage rise pressure above and beyond certain levels, and particularly things, as I said, like housing or wider measures they can see that sort of are feeding through, that they can be confident that if they do take the foot off the accelerator on hiking interest rates, they're not all of a sudden going to have a problem where it bounces back in their face.
So, Marcus, what are you looking out for? I guess what's next? We have retail figures and we have University of Michigan data tomorrow.
Yeah, I'm looking more forward to actually Jackson Hole to get a clearer read. I mean, it's very interesting from what we heard overnight from Neil Kashkari. He used to be the Uber Dove. He's now become the Uber Hawk. But what he's saying makes some sense, is until they can see real clear evidence for quite some while, they're not going to do anything. And they're trying to let the message across the markets that you can't, and the Fed isn't going to give up here. Now, it doesn't necessarily mean they're going to do 75 at the next meeting, but I think they might do, just because to reinforce that message that they don't see an end to inflation clearly yet, and they're going to carry on getting up to that neutral rate, 3.5% to 4%. You know, still, that's very much on target for that.
I know this would be a complete outlier call, but they're behind the curve. They've kind of admitted it. Right now, you know, they could go 100 basis points hike in September and then see what happens.
I don't see that. I mean, it's between 50 and 75. They'll obviously decide, you know, they've got several weeks to go before that. As I said, we'll hear from Jackson Hole perhaps a little bit more in depth, what they're really thinking, what they're really watching out for, and what their forward plans are. The other important thing is quantitative tightening. It's about to ramp up. It's been softened by a Treasury cash balance issue, technical stuff, but we're starting to see basically $100 billion a month coming down from the Fed's balance sheet. That's going to maximize the effect on financial conditions, monetary conditions, along with these big rate hikes. That will be important to see how that feeds through.
Marcus, thank you so much. All eyes on Jackson Hole, August 25th it starts. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Mueller, Kailey Leinz, and Tom McKenzie. This is Bloomberg.
We are entering, I think, a new phase in the inflation debate.
We are still relatively cautious given the ultimate outlook and trajectory for the economy.
What we need to do right now is we need to help bring prices down in a way that sustains the economic progress that we've made.
This is a necessary print for the Fed, but it's not sufficient. We need to see a lot more.
All options should be on the table.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Tech stocks bounce back. US inflation data extends a rally that sees the Nasdaq rise 20% from its lows 2 months ago. Fed officials, though, brush aside the CPI report. They say it will not change the central bank's path toward even higher interest rates. And Disney's big price hike, the cost of its flagship streaming service, is going up 38% to help offset losses at online businesses. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. Kailey, of course, investors still working through this inflation print.
Yeah, and it's still leading to risk appetite after the big gains we saw in the U.S. yesterday. Asia followed right along. The MSCI Asia Pacific Index was up about 1% overall, but really that was a move like we saw in the U.S. yesterday, led by technology. The Hang Seng Tech Index rising 3.7%. So that helped lifting sentiment overall, even though there was some maybe not so great news out of Asia as well that we have to consider, including a report from the PBOC saying it's going to avoid massive stimulus because of the threat of inflation. So maybe won't be as supportive for growth in the Chinese economy, which we know is struggling. As a result, the Chinese yuan weaker against the US dollar by about 0.2%. Interestingly, the Singapore dollar is now actually fractionally stronger, despite the fact that second quarter GDP contracted by about 0.2%, so a bigger decline than was expected. Plus, they cut their growth forecast for the full year. So that weighing a little bit on the currency earlier, but right now the Singapore dollar trading just shy of 137, Matt.
All right, very interesting stuff. We still have futures up here as well. Right now, only about 0.25%, but a real rally yesterday, more than 2% in the cash trade, and we're now up 15% from the lows in the middle of June. Only down year to date now about 11% as the VIX falls below 20. You can see that investors are buying 10-year debt right now, just a little bit up down 1 basis point. The price goes up, yield comes down to 276.98, and you can also see that investors don't really feel the need for the safety of the U.S. dollar. The Bloomberg Dollar Index coming down to 1256. Finally, Bitcoin right now up 2.6% at 24,500, getting closer and closer to that 25,000 sort of range breakout velocity, but it's not quite there yet. So we'll keep watching this space. Tom, you don't really see big gains in Europe either, do you?
No, it's funny, Matt Miller, we started off at up about 0.3% at the start of the session, so that optimism and that handoff from Wall Street was there, but then that quickly faded, and as you're totally right, you're seeing losses now across the major indexes, the likes of the DAX, the CAC over in France, and here in the UK, you're down by about 0.1%. Worth pointing out that energy prices just screeched higher again across the continent yesterday, just underscoring the vulnerability of Europe when it comes to those energy supplies. And of course, we're looking ahead to those OPEC Plus and IEA oil reports as well to give us that sense in terms of the outlook. I should say the CAC current is currently up about 0.1%, slightly more positive over in Italy, up more than 0.4%. Again, across the benchmark, you're seeing range bound, essentially a little bit of a gain there, up 0.1%, but you had seen early gains of more than 0.3% and bared some of that. Euro dollar currently at 103, largely, as you say, on the back of a softer dollar, up 0.4% for the single currency. Siemens, one corporate story worth highlighting. Yes, they have supply chain constraints, and of course, they've been impacted by having to pull away from their business in Russia, but they are saying that they continue to still see pretty decent demand for their products. Nonetheless, getting a hit there, down 1.4%. And Zurich Insurance, a very strong set of results. Morgan Stanley saying that these results were very positive. They are coming out with a special buyback as well, being rewarded up more than 2% for that insurer. Kailey.
All right, so a few stocks to watch in today's session, Tom. And of course, there is a lot else we will be watching today, including more inflation data here in the U.S. This time, PPI will be crossing the wire at 8:30 a.m. New York time. Will we also get a cooler than expected print, and what will that mean for the Federal Reserve? Plus, more earnings will be coming. Rivian is scheduled to release its fiscal third quarter results after the bell. OPEC Plus will be releasing its latest monthly market outlook. So what will that mean for the trajectory of oil prices? And then more Fed speak and potentially more Fed pushback against the idea of a dovish pivot. San Francisco Fed President Mary Daly will be speaking exclusively to us in an interview at 7:30 p.m. New York time, Matt.
All right, we will definitely be paying very close attention to what she says, because softening inflation data in the U.S. isn't changing the mind of other Federal Reserve officials. Two of them said the central bank will stay on the path towards higher interest rates. Minneapolis Fed President Neil Kashkari, for example, spoke yesterday.
The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic. I think a much more likely scenario is we will raise rates to some point, and then we will sit there until we get convinced that inflation is well on its way back down to 2% before I would think about easing back on interest rates.
sitting there talking at the Aspen Institute with Larry Fink, notably. Bloomberg economy reporter Michelle Jamrisco joins us now for more. And Michelle, why do we see a market that simply refuses to believe every Federal Reserve speaker we've seen in the last 3 weeks?
Well, Matt, it seems like we keep asking that question of ourselves. There was certainly a lot of over-exuberance after this latest release. Again, markets seem to be operating on a different timeline and expectations from the Fed. But to put this data into context, we have to think about, again, coming off a 4-decade high. We're at 8.5% on the year-on-year figure for CPI. It's leagues above the 2% target. So, what you'll hear from Fed officials and from like-minded economists is that 1 month does not make a trend. Let's not get all crazy about, what the Fed's going to do from here. They are reiterating their position that the fight is not over against inflation.
Yeah, what happened to Neil Kashkari? He went from Uber Dove to Uber Hawk, and what does that shift tell us about what's happening within the FOMC?
Yeah, well, him among others. I mean, the Fed officials are coming out in full force defending, just as they did before the data, and now after the data, and maybe we'll see it again after the PPI, that their inflation fight is still ongoing. They're pushing back against this idea that the rate hikes are even close to being finished. They're pushing back against this idea that in 2023, perhaps early next year, they'll have to pivot to rate cuts. So you see the likes of Neil Kashkari, as you mentioned, once the biggest dove, now the biggest hawk, talking about wanting to see the benchmark interest rate at 3.9% by year end, 4.4% by end of next year, of course, implying rate hikes over those two periods. So you see him alongside Charlie Evans from Chicago, Mary Daly, as you mentioned, from San Francisco, already coming out with a few remarks post that data yesterday, Washington time, and perhaps reiterating that position in our Bloomberg interview that their fight is far from done. She wouldn't rule out a 75 basis point increase in September. So there's a lot of talk right now about the Fed kind of pushing the messaging back to where they were talking about inflation being number one, and it's still their biggest focus right now. No easing up and little relief from this report.
Neil Kashkari looking for 4.4% next year. Who would have thought? Michelle Jamrisco, thank you for walking through, of course, the impacts and the market reaction to that CPI print. Over to Washington now. President Biden said there are signs that inflation is beginning to moderate after it slowed more than expected in July, giving him a much-needed boost ahead, of course, of those November midterm elections. Meanwhile, Commerce Secretary Gina Raimondo has warned there is still reason for caution. She spoke yesterday.
It is good news, although I do think we have to be cautious. A big reason for the good news, gas prices are leveling off, and that's certainly helpful to consumers. But as you point out, there are other issues like in housing that we have to still keep our eye on the ball. As we've said all along, there's no silver bullet here.
OK, let's get over to Jack Fitzpatrick, then Bloomberg government reporter joining us from D.C. So presumably, and we've heard it from some officials out of the White House, of course, already, they are very pleased with this number, Jack, with the caution, of course, and the caveats. Some of it, and a lot of it is down to gasoline prices. There's a lot of elasticity there, of course. How are they thinking about things going forward?
Well, first of all, you heard the Commerce Secretary say there's no silver bullet, but at the same time, when the White House talks about it, and even when she discussed it, focusing on gas prices in particular, energy prices coming down, that's exactly what the Democrats want to focus on, what President Biden wants to focus on in the big picture, speaking to the public about this. Obviously, this report gave Republicans plenty of fodder as well. The annual rate on the CPI was 8.5%, and that plays into the caution in the optimism that you hear from the administration. But it still, nonetheless, gives them a chance to point to lowering gas prices, and the timing is convenient as they have made progress on their major tax and climate bill that they're calling the Inflation Reduction Act. May not have that much of an effect on inflation, but it's still something that they are sort of branding their legislation on. So a little bit of temporary, short-term, month-to-month good news is clearly welcome for the Democrats, and they're going to continue to play up the gas price angle in particular.
All right, the question is, will the trend continue for the next 3 months until the midterms? Jack Fitzpatrick of Bloomberg Government, thank you so much. Turning now to corporate news, Disney is raising the price of its flagship Disney Plus streaming service by 38%. It's part of a plan to generate more revenue for its money-losing online businesses. The entertainment giant also wants to build on third-quarter results that beat estimates for sales, profit, and subscriber growth. We heard from the CEO yesterday.
And significant subscriber growth at our streaming services, which added 15.5 million subscriptions in the quarter, including 14.4 million Disney Plus subscribers, of which 6 million were core Disney Plus and 8 million were Hotstar. As of the close of Q3, we now have 221 million total subscriptions across our streaming offerings.
Nora Melinda, Bloomberg media reporter, is joining us now for the details. So we see the stock up more than 7% in pre-market trading. What exactly was so positive about this report?
Yeah, so Disney is actually doing quite well and is showing strength across many of its sectors, specifically with parks. You're seeing parks booming. It's clear that vacations are back. In regards to
revenge tourism.
Exactly. In regards to its streaming service, and as he said before, the CEO, 221 million subscribers combined across its streaming service subscriptions. And so it's really showing growth and is clearly rivaling Netflix. And lastly, I think some really important news, they're actually going to be hiking their Disney Plus subscription service prices. So if you want to stream ad-free, it'll cost about $11 a month. So this will be great for profitability for the company.
And this is what investors are so excited about.
Exactly. It'll be super profitable for the company, but of course, consumers will have to take a little bit of the cost on.
And I think the bundle is even more, right? If you want the bundle with no commercials, it's like $14 or $15.
Exactly.
What's the 2024 outlook for, longer term outlook for Disney?
Yeah, so Disney lowered its 2024 forecast, and many people are speculating this is because it failed to renew its rights to stream the Indian Premier League cricket games. It may lose about 20 million subscribers over in India.
Wow, who knew Indian cricket was such a big deal?
I'm saying.
All right.
All right, Nora Melinda of Bloomberg, thank you so much for that report on Disney. Now, of course, Disney, one of the more positive earnings stories that is out there today, and it is definitely moving in pre-market trading as a result. But we have others as well, including Coupon, which is the big South Korean e-commerce company. It lifted its revenue forecast. It's benefiting from higher monthly fees it is charging, so that's improving profitability. That stock is up 6.4% before the bell. It is a less positive story, though, for a few other stocks, including AppLovin, which is the video game company. It is down 8.8% after it missed expectations, suffering from a decline in consumer and advertising revenue given the macroeconomic environment. And then finally, Bumble, also coming up short. In part, this is due to a delay in certain product launches, but that stock is down 7.6% before the bell. So not a great day for that dating app company, Tom.
Okay, Kailey, thank you very much indeed. We're going to walk through some of the key market themes and get some calls from Hugh Gimber, Global Market Strategist at JPMorgan Asset Management later in the show as we adjust, of course, to softer inflation, at least for now. How sustainable is this rally? And Michael Mueller, CFO of the German energy giant RWE, will be speaking to him later in the show as well, as the German Chancellor says gas reserves will be fuller this year than they were last year. They're targeting 80% by November. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Tom McKenzie with us out of London today. I've always found it interesting that in market jargon terms, when we go down, that's volatility, and when we rise, that's calming, even if the gains are incredibly volatile and the losses are rather calm. Nonetheless, that's how it is, and that's what we're seeing right now. The VIX has come down under 20 yesterday, and high-yield spreads have compressed. Anita Takova is with us right now, Bloomberg cross-asset reporter out of London, to tell us why and what's going on in this very calm rally, Denitsa.
Yeah, I mean, if you look across markets, there is a sigh of relief. Just look at the VIX, as you said, 4 months low. And it's not only stocks, like if you look at the bonds volatility is quite low. If you look at currencies, currency volatility is quite low. If you look at the signals we've been looking for a while, like for example, credit spreads, and they rose so much and there was so much talk about recession risks, they have been down significantly. So there is definitely less worry about risky debt companies. And look at the rally. It's pro-risk. We're seeing non-profitable companies rally. We're seeing expensive software rally. And going back to that big rotation of this year, value was the big winner, and everything is reversing. If you look at growth versus value, growth has the best month against value last month in 23 years. And this is continuing today.
One of the biggest moves yesterday, Danica, was in the dollar, of course, down about 1%. Seeing further softness for the greenback today. How should we think about the way that currency traders are looking at the dollar in light of the fact that these Fed officials keep coming back and pushing back against the idea that they're going to be anyway soft on inflation?
Yeah, I mean, the same. That reaction was a little bit retreated today, but it depends what we're going to see from the Fed. We saw a big pushback, but we're also seeing financial condition relaxation, which, you know, that's going into the opposite direction. So again, as markets, this really depends on what are we going to see from the Fed. And so far, the signals coming from the Fed are we're not going to stop. So that obviously is great news for the dollar.
Yeah, the Fed says that, yet the market doesn't really seem like it's listening. So how large is the threat of this move not being sustainable?
I mean, the threat is really big. We're seeing relaxation being very strong. We have this whole conversation about whether this is a one-time thing or whether this is a trend. So overlooking all those things, it will be kind of hard to say this will continue for a very long time. Obviously, there has been a very strong sentiment about this rally that it's going to end anytime soon, and we don't see that. A lot of people have been burned by that. And the rally keeps going. And it's important to say that, you know, momentum is strong, momentum is positive, sentiment is positive, and we're at a very low breadth, so it's kind of easier to sustain that positive momentum.
Yeah, a lot of short covering as well, particularly from the hedge funds, right? Thank you very much indeed. Bloomberg's Danica take over on all things cross assets on the back of that inflation print. More on your market analysis. Check out MLive Go on your terminal, of course. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Tom McKenzie in London. Anna Edwards is off today. Now keeping you up to date with news from around the world, here's the first word. North Korea's leader Kim Jong-un was seriously ill during a recent COVID outbreak. That's according to his sister Kim Jo-jong. She blamed South Korea for spreading the virus by sending what she called dirty objects across the border in leaflets carried by balloons. House Speaker Nancy Pelosi says the U.S. can't allow China to establish a new normal around Taiwan. Pelosi spoke hours after Beijing announced plans for regular military patrols around the island. She said China had been trying to push its way towards its goals on Taiwan before she led a congressional delegation there last week. It's a victory for the U.S. government in its long crackdown on bogus spoofing orders. The former head of JPMorgan Chase's precious metals business and his top gold trader have been convicted in Chicago on charges they manipulated markets for years. Each could face decades in prison, though the actual sentences may be far less. And gasoline prices keep falling in the U.S. According to AAA, the average price of a gallon of regular gas has dropped to $3.99. That's the lowest level since early March. Costs, of course, have fallen due to cheaper oil and relatively weak demand. By one measure, fuel consumption is lower than it was 2 years ago in the midst of the pandemic. Meanwhile, in Germany, German Chancellor Olaf Scholz is holding his summer news conference. He says Russia's invasion is the gravest challenge for Europe and presents a new reality for the continent. He also says Germany will steer its way through the difficult energy crisis, which he doesn't expect to cause social unrest. He also says that the government will be putting forward a third package to tackle the crisis. And Matt, this one's interesting. The government will clarify its possible extension of nuclear power, but I guess no decision on that yet has been made.
I mean, I had the exact same reaction. At first, it's interesting, and then I thought, well, NSS, of course they're going to clarify it at some point because it's supposed to run out by the end of the year, and they have to make a decision. Do they take their nuclear plants offline, or do they extend those operations to continue to supplement power?
And that's going to be, of course, part of the conversation with the CFO of RWE later in the show, as well as we continue to see those lines crossing from the German Chancellor, Matt. Coming up, Hugh Gimber, Global Market Strategist at JPMorgan Asset Management, get his views on how to position in these markets. You're currently range-bound here in Europe. Stay with us. This is Bloomberg. Happy Thursday. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Tech stocks bounce back. US inflation data extends a rally that sees the Nasdaq rise 20% from its lows 2 months ago. Fed officials brush aside the CPI report, though. They say it will not change the central bank's path toward even higher interest rates. And Disney's big price hike. The cost of its flagship streaming service is going up 38% to help offset losses at online businesses. I'm Tom McKenzie in London with Matt Miller and Kailey Leinz, of course, in New York. Anna Edwards is off today. And Matt, we are continuing, of course, to work through the implications of this inflation print and whether or not the rally that we've seen is really sustainable.
Yeah, well, I mean, we'll be asking that question, I guess, until it turns down. Right now, we're looking at S&P futures that are up 0.25%, and we did have a massive rally in the cash trade yesterday. Really interesting that the S&P 500 was up more than 2% because inflation was less than expected, but Disney also got a huge boost because they're boosting prices by 38%. You look at the U.S. 10-year yield, we're down just about 1 basis point right now to 276.98, and we had some real movement in yields yesterday, down as well as soon as those numbers came out at 8:30 a.m. Bloomberg Dollar Index also moved down significantly and continues to fall right now. 1256.95 is the level there. And then Bitcoin is a gainer, 2.5% at 24,486. It does tend to track risk assets, so it makes sense that it would move up with the S&P, with the NASDAQ yesterday. Kailey, what do you see in terms of pre-market movers today?
Well, the big one we are watching is Disney after it reported after the bell. Really a pretty strong report across the board. It beat on subscribers. It beat on parks. It is raising the cost of its Disney Plus streaming service by 38%. So that could help profitability offset some of those losses in the online businesses. As a result, that stock is up 7.4% before the bell. Less positive story, though, for Bumble, the dating app where women make the first move, lowered its revenue guidance in part because of product delays. It's down about 7.4%. And Matt, you were talking about their gains we're seeing in Bitcoin. That is helping out stocks in the crypto-related space. Even Coinbase, despite news yesterday that the SEC is probing the company again, this time related to some of its staking programs. That stock, though, is up about 3%, and Marathon Digital, another crypto-related stock, Tom, up about 7.3% before the bell.
Yeah, here in Europe, you're essentially range-bound across the benchmark after starting pretty strong. There's some sense of caution within these European markets, and of course, just a reminder in terms of energy prices, just screeching higher again yesterday. Economies of euro dollar, of course, benefiting from the strength, or the weakness, I should say, the softness in the greenback, currently gaining 0.3%, trading at 103 on the single currency. And a couple of corporate earnings as well to bring to your attention. A divergent picture between the likes of Siemens, which of course has struggled with supply chains, but also the impact of having to walk away from its exposure in Russia, currently down 1.5%. But executives saying they do still see pretty decent demand for their products in the months ahead. And Zurich Insurance, very decent set of results. Morgan Stanley describing the earnings as strong, and also a surprise and special buyback announced by that insurer, currently up 1.5%. Matt.
All right, so Hugh Gimber, Global Market Strategist, JPMorgan Asset Management, joins us to talk about everything that we've seen going on here with inflation in the Fed, but also in Europe, because we've had some really disturbing developments that don't just involve Russia's invasion of Ukraine or the tighter labor market, rising or fiscal tightness across central banks. Hugh, the Rhine River is set to fall tomorrow to 16 inches, which is going to mean that almost no ships can pass, certainly not those loaded with the coal and diesel that Germany and Europe need. What kind of wrench in the works is this?
So I think this is a fairly significant problem, unfortunately, because if you think about what Europe has been trying to achieve over the past few months, it's really been twofold. It's been about building up gas stocks, which has been going relatively well, and then diversifying to other sources of supply. And that is where there really is a spanner in the works here, given the hit to coal production coming from Germany, given the hit to nuclear production in France as well. Europe can ill afford to be burning down gas supplies now if they can't get those other sources of supply online. And so when you look ahead to the winter, I think the risk of that gas rationing scenario is clearly going up, because it's important to stress you can't wait until January, February, when you see stocks having been run down, to implement rationing then. Those decisions are going to have to be taken over the next month or two.
So how much of that is already priced in? I mean, rationing would be bad, right? Not only, well, we're already starting to see city lights turned off and a lot of local rationing, but when you start to see plants being moved down to just 5 or even 4 days a week in terms of operation, that's problematic.
That's exactly the concern, because when you look at the European earnings picture, today I still see too much optimism in those numbers. European ex-UK earnings expected to be growing somewhere in the region of 14-15% in 2022. I find it very difficult to reconcile that with a scenario where you're seeing significant rationing being imposed across the industrial sector. And we know, of course, that Europe is a typically high industrial, high manufacturing index. So it doesn't even have the same advantage of somewhere like the US, where you see a much smaller weight of manufacturing in something like the S&P 500. So that, for me, is the concern. We've seen over the past couple of years that trying to properly outline the downstream implications of this type of issue, looking really through the supply chain and trying to work out what could go wrong, is really, really hard to do in advance. And my fear personally is that if we do see those rationing setups being implemented, then there are going to be problems in the supply chain pipes that it's just really difficult to see coming in advance.
So, Hugh, where does that leave the ECB then? Inflation is their mandate, but growth is a challenge.
It is. So important to stress, the ECB has a very different inflation picture today to somewhere like the Fed, because you have close to about half of the inflation in the Eurozone coming from energy. The Fed is much more of a labour market story. But I think the problem for the ECB is that the time for nuance is gone here, right? You know, if inflation's at 9%, their ability to look at this and say, well, this is out of our control, this is supply disruption, therefore we shouldn't react, is gone. So I think they do look to press ahead with a 50 basis point rate hike come September. After that, it's really the race for how much more they can get done before the growth outlook slows as we move into winter. And so I think they push ahead next month. After that, I look at pricing and think it's going to be really difficult for the ECB to continue to raise rates as quickly as the market is pricing today if we do see the Eurozone sliding into contraction.
And when you look back at the US, with yields coming off as they did yesterday, of course, we still have that inversion, very pronounced between the 2s and 10s, about 40 basis points the last time I looked, or a little above. How does that play into your views on the growth story? Does that have legs in this environment?
So I think the challenge here is whether or not you're going to really see cuts from central banks in 2023, because the rally that we've seen in growth stocks is not just about inflation coming down. It's also about the market getting more confident that as we move into next year, you're going to see some of these rate hikes being taken out. And that, for me, is the challenge, because you look at those US numbers yesterday, and the market reaction, first of all, was, oh, this is great. You know, we've seen a significant drop down, but then the details of that start to say, actually, this is just an energy story. And therefore, I think the Fed is probably more likely in the pause camp than the cut camp for 23.
Okay, well, obviously, a lot of that is going to depend on how close inflation is to its goal of 2%. Hugh, how low do you realistically think we can get by the end of this year?
So if you're looking at the US, I mean, simple math says, give us another 5 prints of no month-on-month inflation, you're still looking at inflation in the US running above 6%. So I think in that scenario, the Fed would take that if you offered it to them now. But the challenge next year is going to be not getting rid of the energy story in the US. It's rather going to be breaking the back of the more structural, persistent inflation that we see building through the labour market. And that's where I think one of the big debates next year is going to be how tolerant is the Fed of inflation somewhere between 3 and 4%. Because if they find that they've got inflation back down to that level, I think you could well be seeing a scenario where the discussion at Jackson Hole in 2023, for example, is all about, is 3% the new target? Are they actually willing to say, we're okay with above target inflation because of that trade-off between growth and price pressures. But at the moment, that's just not a discussion that they can engage in.
Right, and they have told us as much, Hugh. I mean, we heard from Kashkari and Evans yesterday both saying we think we're going to need to hike into next year. Kashkari would like to be at 4.4% at some point. Does the market have it wrong? Why aren't they listening?
So I think the market is just taking what it can get from the move that we've seen back down in yields. My question mark here is how sustainable is this sort of perception of the policy pivot from the Fed really going to be? Because you saw it wasn't just the hawks on the Fed coming out yesterday, it was the Kashkaris of the world, as you rightly highlight. Typically one of the more dovish members of the FOMC still coming out to say, no, we still have more work to do. So if you're buying growth stocks today, I think you're putting very high conviction in the rates market settling down and leading into a lower path of interest rates as we move into next year. That, for me, is just difficult to really put too much weight on at a time where those sort of sticky inflation pressures, particularly coming from shelter and the housing market, look to be quite persistent.
Yep, if inflation is sticky, how sticky is this rally? Hugh Gimber, Global Market Strategist at JPMorgan Asset Management, thank you so much. And speaking of Federal Reserve officials pushing back, don't miss our interview with San Francisco Fed President Mary Daly. It's an exclusive tonight at 7:30 p.m. New York time. What will she have to say about yesterday's CPI and today's PPI data? So tune in for that. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You are looking live at the Principal Room. Coming up today on Bloomberg Technology, an exclusive interview with Pinterest CEO Bill Ready. That is at 5 p.m. New York time. This is Bloomberg.
This was a good report.
This data allows us to breathe a sigh of relief.
It's nothing like we are out of the woods.
The Fed still has plenty more work to do.
We do not expect that we are finished.
The Fed is still going to hike in September.
This is still a go, perhaps for 75.
Our goal is for 50.
50 basis points.
We're looking back at 50 basis points. It looks like it's going to be 50, 25, 25, which is a more moderated pace. That is still a ton of tightening.
I expect at the end of this year, the federal funds range will be 3.25 to 3.5%.
The market's not believing that the Fed has yet done enough to bring inflation down anytime soon.
This is just the first hint that maybe inflation is starting to move in the right direction, but it doesn't change my path.
Some guests there on Bloomberg Television weighing in on yesterday's U.S. inflation data and its implications for Fed policy. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now to share his take on CPI and his single best chart. Tom, before I get to the chart, I have to say I was in the gym yesterday at 8:30 watching your program, and there was a little cheer when the numbers came out. Everyone was really excited to see inflation at less than it had been anticipated.
Kailey, help me here. I mean, Matt Miller's going to Nerd Gym. I mean, that's what it is. Everybody else is watching Love Island, and Matt Miller's watching the CPI report with 40 other lonely hearts. Matt, it was a very important survey yesterday, and I would consider this one of the most important Thursdays of the year. Every single bear strategist, every single yields higher strategist in bonds has to look in the mirror. They have to publish this weekend and readjust and recalibrate off a bang-up jobs report and a bang-up CPI report as well. Let's look at how far we've come right now. This is the Dow Jones Industrial Average through the pandemic, the great bull market out of the pandemic, the market top, and then over we go in a great bear market. And we are 10.3% away from getting back to that record high. It has been sudden, and I tell you, the winds changed yesterday. Michael Purvis at Tallbacken strongly goes bullish yesterday about 4 p.m. with a 4,400 SPX target.
4,400, there we go. We're looking at corporate balance sheets that are healthy. As you say, NFPs came in, of course, very strongly above 500,000. Then the CPI print. Is this a Goldilocks scenario? Every guest we've had on here in Europe has said, caution here. The Fed is going to continue to pursue these hikes.
You're absolutely right, Tom. And I got to be very careful here. I got to keep my opinion out of it. Of course, it's easy because I'm in the triple leveraged all cash fund. But the answer is there are points of the year where strategists have to really recalibrate. And we hit one of those points at 8:30 yesterday. And that's why you're getting the whoa stuff. And that always turns into either unemployment or it turns into a new view.
So in terms of a new view, is the phrase bear market rally now out the window? I mean...
No, well, I can't determine that. You can never see that in the present, and certainly not ex ante. It's always in hindsight, always in the rearview mirror. I'm not willing to say that, Matt. What I'm willing to say, and I've said this to John and Lisa, corporations adapt and adjust to the cards they're given. I've been saying that since the beginning of the pandemic, and you've seen that with selected corporations. Others have not.
All right, fantastic lineup coming with Tom. Katie Kaminsky is going to join them, among others, from Alpha Simplex. Definitely a program you want to be watching this morning. Coming up, Michael Mueller, CFO of the German energy giant RWE, at a time when, his job has grown probably more complex than ever. Not only have they got the crisis in terms of the Russian invasion of Ukraine and the gas shipments formerly in the Nord Stream 2 pipeline. That's not going to happen. A Nord Stream 1 at extremely slow levels and the Rhine at very low levels. We'll talk to RWE. This is Bloomberg.
I mean, this is not an either or. It has to be a both and, because we cannot magically get sort of tens or hundreds of gigawatts of renewable energy before winter. So it is a matter of saving energy. It's a matter of securing sources of short-term energy supply, and of course, then more strategically to get the independence from fossil fuel imports. And by the way, also to combat climate change, we need to keep the push long-term and mid-term to roll out and accelerate renewable energy.
And that was Ørsted CEO Mads Nipper on energy supply and renewables earlier today. Germany's biggest power producer, RWE, is investing more than originally planned on building domestic supplies of renewable energy. That's as Europe faces its worst energy crisis in decades and is racing to boost supplies ahead of winter. The CFO of RWE, Michael Mueller, joins us now. And we just heard as well German Chancellor Olaf Scholz speaking. He said a number of really interesting things. Chief among them, I think, is that Germany is aiming for energy independence. Do you think the country can get there, and how long will it take?
Yeah, I mean, first of all, the direction, I think, is very clear. So in the current situation, we just see a large dependency on fossil imports. And so the medium-term way out is really to become independent from that. But for sure, that's not a topic that can happen quickly. I mean, the first step, obviously, is to become independent of Russian supplies, which in the end can only be managed by additional imports, mostly LNG, where also capacities need to be added. And then in the longer term, obviously, it's the build-out of renewables. But that's a topic that's going to last 10 or even more years. But very clear, both are activities that need to start right now.
Let's start with the first. You have quadrupled your supplies of LNG to Europe in the first half. How do you see LNG supplies from RWE in the second half? And what kind of prices do you see at the end of the year in terms of gas?
That is difficult to predict. I mean, what we're currently seeing is that basically all the capacities to import LNG are maxed out. Yeah. So therefore, there is, well, I would expect if the scarcity persists, we will probably be at those levels, but that unfortunately there is not more to come. Concerning prices, that is difficult to predict because, I mean, ultimately it depends on temperatures in winter. It also depends on how much Russian actually is delivering in the end. So, yeah, difficult to assess. Plus, what we also see is that markets are not very liquid anymore because simply traded volumes have gone down, and that is obviously also boosting price levels.
Michael, you talked about that. So let's talk about the renewable component. So you're spending about $5 billion, the equivalent of about $5 billion US dollars. Talk to us about that. You mentioned 10 years as a time. Is that the time frame you're looking about, and in terms of when that renewable component comes online for RWE? And do you expect spending on renewables to remain elevated at those kind of levels in the years ahead?
Well, I mean, first of all, investment cycles are somehow different depending on the technology. So I would say if we invest now money into offshore and onshore, that's going to come online in 2 or 3 years' time. So that's pretty short cycle. But if you talk about energy independence, you don't just require the projects that are currently underway. We have to massively ramp up the number of investments and projects that is needed. So therefore, that's the longer term perspective.
How bad does it get for Germany and German industry and indeed households if you get a full cut-off of Russian gas leading up to this winter? Do you expect to see blackouts? Is rationing going to be inevitable this winter?
Well, that's difficult to assess, and I guess that's more a topic you need to ask the grid regulators and operators that look into that in detail. But I mean, what is very clear, if you simply look at the balance, in case the Russian flows would completely stop, and the import from LNG and also additional import from especially Norway is maxed out, there will be a delta, and that delta can only be met by less consumption. Now, the question is how we manage that. I mean, we're already now seeing that demand is reducing because both consumers and also industry are ramping down their production. And that's ultimately the way that will happen in winter. But as I said, it also depends on what the weather going to be like, right? Both wind-wise and temperature-wise.
Yeah, I mean, we are already seeing cities that are turning lights off, major cities across Germany, and we could see, obviously, factories reducing capacity, depending on the weather, depending what Russia does. But Scholz does say that gas storage, in terms of what Germany has right now, is more than what it was. The reserves are fuller than last year, I think, is exactly what he said. Does that give you optimism?
I mean, first of all, if you look at gas storage across Germany, they are about on the level we had previous year. So I wouldn't say that they are above the level. If you look at our storages, we are already far above the average in Germany. So we have about 85% of our capacity filled with gas. I think that is a good news, but at the same time, we also have to bear in mind that if you start into the winter, you have to have full storages plus, in addition, additional supply coming in. So the gas storage itself is not sufficient.
Michael, really appreciate you putting up with us. I know normally you're used to just going through numbers, and right now we're just talking about supply and shortages. Appreciate you joining us. Michael Mueller there, the Chief Financial Officer of RWE. We are, looking at what could be a really difficult winter, Tom, depending on what the Russians do and depending on what the weather does.
Yeah, a petition here in the UK to stop paying your bills as well as you look at $5,000 per household. Stay with us. This is Bloomberg.